Welcome to our class in finance. We're going to look at question number 2. It reads, if the risk-free rate of a return is 8% and the market return is 10%, the market risk premium is 4% and the stock beta is a beta of 2. Calculate the rate of return. So this is under stock valuation using the CAPM model. How do we calculate the rate of return? The cost of rate of return is equal to risk-free rate plus beta. We have the expected market return minus the risk-free rate. So what are we given here? The risk-free rate is what? 8%. The market return is what? 10%. So this collectively is called the risk premium. Sometimes may not be given the market rate. Sometimes you may just be given the premium. So we've been given what? Risk-free rate 8%, the market return 10%, the market risk premium is 4%. The beta is 2. So we're asked to now calculate the expected return. Okay. So how do we calculate expected return? The risk-free rate is what? 8% plus beta is 2. Then market return is 10 minus risk-free rate, which is 8. So this is 8% plus 2 times 2. So 8% plus 4%, what we get? 4%. So this is how we calculate our rate of return. That is our 5 max. Is that clear? We're together?
The screen is black.
Is it still black? Is there a black?
No. Okay. No, I can see no.
Oh, all right. Then
Sorry, before you proceed, that 2 by 2.
pardon?
The 2 by 2.
10
Where
minus
did you get from?
the beta.
Okay, 2. Oh, okay. Okay.
Okay. Right. Then we go to calculating our okay. So the next question is asking us, what do you understand by the efficient market hypothesis? What do you understand by the efficient? This is 20 marks. Okay. Ever heard of that?
No.
An important theory that you must know in finance. When you're defining the efficient market hypothesis in terms of its related forms, basically it looks at it's a financial theory which states that assets or asset prices are like stock prices because they fully reflect all the available information. And also this means that it is impossible to consistently achieve a higher than average or risk adjusted return because number one, the current prices will always be fair. They will represent the best estimate. Number two, the price changes are random, so they can reflect new information. Since news is by definition unpredictable, or they can also reflect future movements, which must be unpredictable. So they follow a random walk. So the EMH is a theory that argues that there is no undervalued or overvalued security for long. So there are three important forms that you need to know. There's what we call the weak form, there's what we call the semi-strong form, there's what we call the strong form. So in the weak form, it assumes that all past data is reflected. It's historical data is reflected. So the implication for investors is that technical analysis is useless because the future prices cannot be predicted by analyzing the past price patterns. So can this analysis beat the market? No. Then the semi-strong one actually asserts that all publicly available information, be it the news, financial statements, all these prices adjust rapidly with the public news that you cannot profit from. So it cannot also be analyzed to beat the market. Then we have the strong form, which asserts that all information, public and private, inside information, that even insider trading is useless. Even if you're in there, you're given a chance to predict, to know what is happening in the firm. Prices actually reflect all secrets. So this is a theoretical extreme and cannot be considered true in reality. So it cannot beat the market also because in practice it is false. So these are three forms that you need to know. Okay. So good question number 3. Question number 4, discuss any 3 major types of projects considered when a firm is making expenditure decisions. What 3 major types of projects are considered when a firm is trying to make a major expenditure decision? Can you try question number 4? Can you hear me either? Okay. I'm assuming you already know it. I want you to participate. What are the 3 major projects that are considered when a firm is making capital expenditure decisions?
I'm not sure. I didn't really get the chance to go through this.
Okay, so there are 3 important decisions that are 3 types of categories. There's what we call replacement projects. These are mandatory in nature. So these are expenditures that are there when you want to replace worn out or outdated equipment. And you want to keep the current operations profitable. So the main goal is basically to ensure that the business will continue functioning efficiently without disruption. So examples could include replacing old delivery van, outdated machinery on production line. So the first type of expenditure is replacement projects. The other one is decision-making process. Is expansion projects. And we also have mandatory or safety projects. Mandatory, regulatory, and safety projects. In short, they're called compliance. I repeat, there are three major types of projects that you need to consider in capital expenditures. Number one, we said replacement. So replacement here, you have to replace outdated or worn out equipment with current ones. Then secondly, we have expansion projects. These are investments that are aimed at what? Increasing revenue generation and capacity for the firm. So it's often driven by growth objectives, and these are crucial for long-term survival. For instance, if you're expanding the market, you want to enter new geographical markets, you have product expansion, you have to launch a new product line. Capacity expansion, you have to increase output. All right. And mandatory and regulatory or safety projects. So these are investments required by law. They are necessary to ensure that there is a safe work environment, there's a legal continuation. So these are often non-revenue, but they're very critical for risk mitigation. So examples, we'll look at installing control pollution, etc. Okay. Then question number 3. What do you understand by cost of capital? Question number 3. What is cost of capital? You must understand that what? There's a minimum rate of return that a company must earn to maintain the market value to attract funds. So the cost of capital is simply what represents the opportunity cost of funds for providers of capital, like the lenders or shareholders. So in other words, I'm talking about cost of capital. It is a return that these investors expect to receive for investing their money in our business. So it may not come from a single person. We can come from different sources. It can come from debt capital, it can come from preferred stock or common equity. All these, when they are weighted together, we call them WACC. So WACC is another topic that we'll look at in depth. Okay, so this is 5 marks. So cost of capital is a basket of the cost of you using what? Using other people's funding, in short. They discuss the benefits and disadvantages of using debt capital. Why is it important? What are the benefits of using debt capital? Number one, the major benefits are you are going to have a tax advantage. So the interest payments on debt are tax deductible. So meaning to reduce the burden, to reduce the company's taxable income and its overall tax liability. So it will make it cheaper as a source of finance compared to equity. Number two, it has the benefit of financial leverage. So if a company earns a higher return on its investment than the interest rate it's paying, so the excess will be a benefit. So if you're getting Kongole of 100,000, then you're only paying 10%, compared to you straining to look for ownership from people who you wouldn't want to be part of the. So if the company earns higher return on the investment, so if you're borrowing 10,000 and it's giving you 20,000, but you're paying an interest of 1,000. So the benefit, if it outweighs how much you're borrowing, then it's a good. The other advantage is that retention of ownership and control. So when you're issuing debt, you don't dilute the ownership of the business. So the shareholders remain as they are. Unlike when you need money and you start issuing shares, so you dilute the ownership, you have new members. So those are the advantages. The disadvantages, remember this is 10 marks of debt capital, is there are fixed financial obligations. So the interest payments and the principal repayments are mandatory. So if you default, you have legal consequences. Number two, you have increased financial risk. So you have high levels of debt increase, and this will give you a risk as a firm, which will lead you to a required rate of return. Then number three, you have restrictive covenants. So lenders will give you and impose restrictions on how the loan must be repaid and how you must use the money. So the restrictions that are there. Are we together? Is that clear?
Yes.
All right. So now let's look at how to calculate the cost of debt. So here we said debt is what? Tax deductible. So we want to calculate the cost of debt. Cost of debt is simply cost of debt times pre-tax times the tax shield. So this question number 3B, what are we given? So cost of debt is simply given by what? AD is equal to cost of debt pre-tax before tax and the tax shield. The tax shield is 1 minus tax itself. In this case, what are we given? We're given the cost 15% is cost of debt, this is KD. And the tax rate is what? 30%. So the cost of debt here, we're going to have what? 15%. 1 minus tax. 1 minus 0.3. So when you complete this, the answer is simply going to be what? 10.5. Are we together? As simple as that. That's how we calculate our cost of debt after tax. Then we go to another kind of debt, which is preferential shares. Okay, these are called prior debt because they have what? They are speculative investors. They don't actually own the business. So to calculate the cost of preferential shares, simply the dividend paid now over our price of stock now, the PO. So we're told that we have a what? 10% redeemable shares with a face value of 100 that is issued for a price of 95. Compute the cost of what? The cost of debt. So we want to calculate the annual dividend value. It's simply the DP. So the DP is simply a percentage of the face value. So dividend paid is 10%. So 0.10 times the face value. The face value is how much? 100. So when you calculate this, we're going to get the dividend paid as $10. Okay. Now, also divided by the net proceeds from the issue price. So the issue price was initially 95. So 95, we subtract the, because this is an irredeemable perpetual preference share. So we subtract the 10 from the 95. So we're going to have our PO at 95 minus what? 10. This is 85. So now this we calculate. This is equal to 10. It's $10 over 85. So this will give us 11.76%. Okay. So This is what we had today. How did we calculate the expected rate of return here? Do you remember? AE is equal to what? Risk-free rate plus what? Beta. Risk-free minus what? Expected market return minus risk-free rate. So here we said we start with a risk-free rate 8% plus beta of 2 times 8 minus 8% minus or 10% minus 8. So here we're going to have a 12%. Remember this, right?
Yes.
Okay. So we've answered all this within a short period of time. So what was complicated?